Mahesh, fantastic to have you. Thank you for joining us. Mahesh, I actually have to open a dictionary these days rather than a finance book because in last 1 year we have perhaps seen all shades of market behavior: fear, financial armageddon, panic, gut-wrenching fall, euphoric recovery, participation, FOMO. I don't know what else is left. In last 12 years, we've seen all shades of human behavior apply to the market. What do you think is the dominant flavor right now, and what will dominate this year?
Yeah, so I think you're right. I think, Nukunj, let me welcome all our viewers and our partners to this Voyage 2021. So last year was, it was a kind of a two halves, right? First half, where we've seen bull and bear and bull markets in 1 year, right? And in many ways, I think it was extraordinary. And especially for fund managers like us, the kind of volatility what we saw, it was really a difficult period. But I think coming back, I think as we step into this decade and look forward, I think we are filled with a lot of optimism. I think really from pessimism, I think we have moved to the other extreme. And there are multiple factors to that. We are seeing, I think this is the beginning of a new era, beginning of a new cycle, new economic cycle for India and for the markets. And it's predicated on many things. We've seen after the crisis, just like any other crisis, all the central banks globally have come together and pumped in huge amount of liquidity. This time around, the total fiscal stimulus which was there was 3 times of what we saw during the global financial crisis. Almost $13 trillion of expansion of balance sheet by the top G4 nations, which is humongous. And low interest rates. Interest rates are almost zero in the US. And more importantly, the central bankers have ensured that they'll keep interest rates low for the next 3 to 5 years. So in this environment of abundant amount of liquidity, low interest rates, we've seen the reflation of the economy very sharply. It's almost a V-shaped recovery, which has been there. And India also, while India was slightly behind, right, because we had extended period of lockdown, we are also seeing that play out. And more importantly, I think from India perspective, we have been actually going through a slowdown even before the crisis, right? Our GDP growth, which was around 7 to 8% in the early part of the last decade, it came down, and just before the COVID crisis, it was say around below 5%. So we went through multiple challenges earlier. We went through a major set of reforms. Modi 1.0 was a period where we saw large ticket reforms, the GST, the real estate regulatory bill, the IBC, the banking and financial services sector reform, and all that took its toll, in terms of the economy and also in the corporate earnings growth. But as we step into this decade, we have seen this government actually, and especially after this budget, I think there is a big change in the overall narrative what we are seeing, right? Earlier, the focus was more on fiscal consolidation, trying to take care of certain issues which were disruptive. But now I think the focus is clearly on growth. And the budget also allowed for fiscal room to ensure that growth comes back. And we've got fiscally, the government will be accommodative at least for the next 2 to 3 years. And on back of the foundation what we have created, right, the reforms, I think we should embark on a new growth journey from here. And earlier it was mainly driven by consumption in the last 5 years. I think investments are also, we think, will pick up. Various efforts taken by the government to stimulate investments through the Make in India initiative, the production-linked incentive schemes. And we had a panel yesterday, right, about the manufacturing panel, and they talked about all these steps which are taken, which will actually be another pillar of growth, right? So we have consumption, which is there, investments, which was kind of going slow and declining actually in the last 4 or 5 years. I think that can revive. And again, real estate sector, which is another large component, part of the GDP, has also been in a down cycle for a long period of time. And the conditions are now favorable for the sector to also pick up. with interest rates now below 7%, which is like what it was 13 years back, right? And an affordability gap, which was large, has come down because property prices have remained stagnant. And overall, the consolidation, what we see in the real estate sector, and the confidence of buyers is now gone up, right, in the new projects under the RERA Act. So all these things are signaling to us that we would actually see GDP growth in the coming decade, okay, to be somewhere around 7% or even higher, 7 to 8%, which is a potential growth rate. And the last decade, actually, we were going slightly below that rate. And that optimism is what we are taking forward into this decade, and that is going to fire up the corporate earnings, profitability, and we have made a good start to this calendar year. I mean, profit growth in this third quarter for Nifty earnings is already showing at around 25%. Mind you, this is at a period where we're seeing actually GDP contracting, right? So the corporate India has responded fairly well during this crisis. They've been able to put themselves together, look at initiatives to cut costs, improve efficiency, and I think that will carry them through going forward into the coming years.
Mahesh, I would ask a very basic question, which is that the comeback in the market has been nothing short of unreal. From throes of the pandemic, Nifty is up more than 100%. 7,500 is almost 15,000 now. The general fear amongst this attendee audience and a lot of audience whom we interact with and a lot of unit holders and investors is, has the train left the station? Is it too late now? Will this sustain? There is a fear of dar. How would you fundamentally justify that this is just the beginning and not the time to get worried, but time to participate?
Yeah, I mean, that's question which gets asked every time. I think every time the market hits a new high, people say, okay, we yahan se kahan jayenge, right? So let me put things in perspective over here. While there's no doubt that the market has rallied sharply from the bottom, and it's looking a bit expensive also on a P multiple basis. But see, market is at one end. But if you look at the economy, right, because finally market is slave to the earnings. So economy, actually, we are at the bottom, right? So if you look at the data points, corporate profit to GDP is at 1.8%, which is what it was in 2003. Right? At peak, it was 7%. So clearly, corporate profit to GDP is at all-time low. And from here on, the way if the recovery happens and what we are looking at, and the way corporate India is really working in terms of improving profitability and margins, and there's enough room for corporate profits to expand from here over the next 4 to 5 years or even beyond that. And so I think in the coming years, I think you will see the corporate earnings growth actually surprising us positively. And if you look at in the last decade or so, right, if you just see another slide which we have, in the last decade, corporate earnings growth was just 5%, right? At a time when nominal GDP growth would have been around 10% or so. And that time, Nifty gave a return of around 10%. What we see is now, as things normalize, okay, there'll be some catch up because it has been growing below the normal trend line of around 12-13%. Then if earnings growth in the next next decade is going to be in the mid-teens, then returns even from here, right, can be in the low teens is what one would expect. Even if you factor the current high valuations, I think earnings growth will really compensate for that. So I think this is just the beginning of a big cycle what we are looking at. And if you look things in perspective, from here on, I think markets will continue to scale new heights is what we think. Obviously, there will be pullbacks, right, because the rally has been too sharp and too fast. But I think that's something that should not really miss the longer term picture, okay, what one is looking for, because I mean, equity investing is not all about staying invested, right? So I would say definitely people haven't missed the bus. Even this is also a good time to invest, and that's what we are seeing. Even from here, investors would make decent returns. When I say decent returns, means say around 10 to 12%, which is not bad in the context of where interest rates are and where interest rates are going to be in the medium to long term.
If I may ask a fellow Mumbaikar in Mumbai terminology, let's say if the train has to go from Churchgate to Kandivali, Where do you think the equity market range has reached?
Okay, I would say the train is somewhere around Lower Parel, okay, where our office is, right? So we are probably somewhere around, say, whatever 20% of that journey, right? So I think it's still a long way, right?
20% of the journey, which means this decade belongs to India. What you are saying that if after 100% rise, if markets have recovered, if after 100% rise, we've only traveled 20% of the earnings potential and the economic potential, that means next 4 5 years we are in for a good
So
return.
I'm not really looking at from the bottom, really, right? Because bottom would be a wrong thing to this thing. But overall in the journey, okay, what we started, right, in this calendar year, I would say, okay, we are still a long way to go.
The other problem is when there are monsoons, the rain does not go. So in again Mumbai terminology, the monsoon here could be inflation. The monsoon here could be our over dependence on FI flows, and the fact that we are going through a patch where, in a sense, we are hostage to FI activity, aren't we?
That's true, actually. If you look at the run in the market also, I mean, why the market, people are surprised why the market has gone so much, right? When earnings, I mean, around it's still recovering, but not to that extent. So it's primarily driven by the FI flows. And I mean, that is, in fact, in India, if you look at the last 2 decades, right, there are only 3 periods, okay, when FI flows are negative. So traditionally, foreigners have been bullish on India despite the various ups and downs what we've seen in the Indian markets, right? And that trend, I think, will continue more so now because we are seeing a big emergence of emerging markets going forward. I mean, last decade was a decade for developed markets. Developed markets did fantastic, and so the US, which was a large market, has given almost 12% return in dollar terms. I mean, India has just given around 3% returns. So actually, if you just come back, I mean, to ask a question, I mean, there is still a lot of room for India to expand going forward, right? Our dollar returns have been just 3%. So I would say foreign investors like growth, right? While globally we've seen growth recovering, it's only transient. It's been propelled by the fiscal stimulus, right, and the easy monetary policy in the developed markets. Just once that starts to pull out, you will see growth coming down. India, on the other hand, has got structural drivers for growth going forward. I mean, we have given a fiscal stimulus, but not to that extent. We have cut interest rates, but interest rates are not zero, right, in India. They're still pretty decent. So I think in India, in the current context, if we grow at around 7-8%, I think India will be the fastest growing economy. I mean, the last decade, it was China, which was driving the growth in the emerging markets. I would say in this decade, it will be India which will be driving growth in emerging markets. China growth will probably be around 6% or so. And if that is the case, with the amount of liquidity which is there, and liquidity will chase growth wherever there is growth, right? So I think I see, in fact, last year, in the whole crisis, we saw FI flows in a calendar year was around $20 billion. And as the outlook for India and the narrative for India is looking good and growth is coming back, I would continue to see foreign flows coming in. And that would actually provide the liquidity. I think India is not only foreign flows, FI flows, but also FDI flows, which are important. And India is a capital-starved economy in a way. Our savings are not good enough. And even the capital markets require, companies require to raise money to fund their growth. So I think that whole liquidity which is there globally, I think will come in, and in a way it is a kind of a self-virtuous circle, right? You get more liquidity, okay, that funds your growth, okay, you get growth. So I think we're getting into that virtuous cycle, and FIs and foreign investors would actually be feeding that.
Okay. Mahesh, you're talking about trains, let's talk about food. And the current market is, in a sense, looking like, I feel like a kid in a candy store, because suddenly everything is doing well. IT companies are expanding, pharma companies are growing, banks have made a comeback, Asian Paints reported great numbers for the quarter gone by. Auto companies are saying that there is more demand and there is less supply. Every bull market has the leadership. That's what historical bull markets have done. Is this bull market different, or this bull market will also throw up its unique set of leadership stocks?
So if you go back and look at in the last decade, which were the sectors which did well? So it was technology, it was consumer, it was pharma, it was banking and financials. But within banks also, it was mainly the private banks, which are more structural stories. So it was essentially the steady sector, right? Okay, which high quality sectors, as you may call it, or more secular sectors, which were the leaders in the last decade. I think these sectors will also continue to do well. I think India consumption will continue to be a steady long-term story. IT sector also the outlook looks fine, but I think some of these cyclicals, okay, which had underperformed in the last decade, I think you could see a revival of those sectors again. It might not last out throughout decade because cyclical sectors normally play out over a 4 to 5 year cycle. But at least in the coming years, we see a resurgence of some of the domestic cyclicals. So that could be either the industrials, the capital goods sector, even the banking and financial services sector, consumer discretionary, auto. I think these are some of the sectors, okay, which would probably do well in the coming years on the back of strong domestic recovery, better earnings growth, and also some potential for re-rating because some of these sectors are still below. Their valuations are not really at astronomical highs as what we are seeing in some of the defensive sectors. So we are looking at some of the cyclicals really doing well, at least in the next couple of years.
Mahesh, are you pleasantly surprised with the numbers what banks have reported? Because at the peak of the crisis, it appeared that NPAs will go higher. Retail delinquencies would be in record high. Bankers themselves were running for cover. They themselves were raising capital. But look at the numbers they're reporting.
So yeah, I mean, during the COVID crisis, the bank stocks got beaten down the most, right, initially. And see, the banking sector went through the large corporate NPAs at the 2 years back. And banks were kind of stressed, and they're coming out of that. And COVID crisis actually put a test on the retail credit cycle, right, which had done very well. Last 10 years, retail credit has behaved very well. And this was a true test for the retail credit portfolio of the banks. And I think coming out of this cycle, we've seen that that's behaved fairly well, much better than expectations. I mean, overall NPAs, one would expect gross NPAs to be around 4 to 5%. I think they would be around 2% or so. So I think the overall NPA cycle, especially the retail credit cycle, has come out with less scratches, I would say. And the recoveries, bank recoveries are now back to around 95, 97% or so, except probably in a few sectors like the microfinance sector or unsecured credit, and to some extent in the small and medium enterprises. But by and large, it's come out well. And I think the banking sector also, some of the large banks, they have been able to strengthen their balance sheet. They have raised capital during this crisis. The capital adequacy ratio is fairly large. And I think the whole banking sector is now really geared up, okay, to take on the challenge in terms of funding that growth, right? Credit as GDP growth picks up, nominal GDP growth. Next year, we're looking at around the mid-teens. Banks are ready to really fund that growth. And balance sheets are also, as I said, the total capital adequacy ratio is fairly good. So I think the banking sector is the core, right? Is the backbone of the economy and a large component of the market. So the way I see it, this sector, okay, would again continue to. It's already been leading the rally in the last 3 months, and that will continue going forward.
So what kind of orientation would you propose one should have in their portfolio, and where, and because we've got attendees who are also investors and distributors and your partners, so they would like to understand that what kind of positioning would you propose in the schemes which you personally manage and also your fellow fund managers are managing?
So I think another interesting trend, what we are seeing and what we believe will play out is that unlike in the last couple of years, 2-3 years, where we've seen the market was slightly more narrow, right? It was only the top 4-5 stocks which drove the market. I think the breadth of the market is likely to improve. And we're seeing that play out in the last 3 to 6 months. And the reason for that is that we're seeing now many sectors firing. It's not just a few sectors which are doing well. The domestic recovery, what is playing out, will benefit the mid and small cap companies. And to that extent, you would see the breadth improve. And in that kind of a market environment, you would expect across the spectrum, large cap, mid cap, and small cap would do well. Obviously, the better companies and companies which manage the business well will only emerge winners over there. In that context, we would suggest a large allocation towards a multi-cap fund, right, which is able to play across the market cap spectrum. So larger allocation should be in a multi-cap fund, followed by a large cap fund, because the large leading players will continue to do well. They'll go steady, and we've seen this theme of big becoming bigger, right? And especially after the COVID crisis, there has been a consolidation amongst the larger names. So that will continue to be a steady, but and some allocation to the mid and small cap sector would also be advisable, because one would expect the sector, the mid and small caps which have underperformed in the last 3 years, will bounce back and could do better on the back of domestic recovery. And also for investors who are worried at this point in time, right? A lot of investors are worried what to do. I mean, rightly said, markets have rallied so much, valuations are looking expensive. Whether to invest into this market or to wait. So for those confused investors, I would say the best way to come through is a kind of an asset allocation fund or a balanced advantage fund, right? Where the fund manager really decides on the allocation towards equity and debt, depending on the market valuations and depending on the market cycle and the macro conditions. So, and that could be a good alternative for investors to look at if they are uncertain, because I mean, in there, the fund manager would decide on the asset allocation. And considering the fact that interest rates are low, I mean, I would say putting money into fixed deposits more than what you require for the next 2-3 years, okay, is not going to really give you even your inflation returns. So if you want to really put that money and worry about the market, then a fund like an asset allocation fund or balanced advantage fund makes a lot of sense, because there the volatility is much, much lower than a normal equity fund. And there the timing of the market is not really a question which you are worried about. And investors who want to take a slightly higher risk, right? Like Nikunj, I think you are a higher risk taker, I would say. For them, I would say they look at thematic funds, right? So on the thematic side, one could look at banking and financial services sector fund. Is done well across the cycle. And if you really want to play the recovery, right, the broad-based recovery in the economy, I mean, that's a classic play on the economic recovery.
You know, I'm going to bring this point out since Mahesh called me a high risk taker. I would say that I am happy to digest not risk, but perhaps digest volatility. So Mahesh, let's spend some minute or two in discussing a classic quote which we've often discussed, but somehow a lot of people don't implement. And that quote is that in a bull market, the biggest risk is the risk of not participating. And in a bull market, more money is lost while waiting for the correction rather than when the actual correction occurs. We've seen that what happened to the markets. In the run-up to the budget, they corrected 5%, but once budget was applauded by the markets have gone up 10%. Do you think that is one mistake? People who are attending this conference, people who are not investing right now and waiting for the correction that sasta hoga to lenge, are they missing on this lifetime opportunity? Because when the correction will occur, it may give you an entry point, it may not give you an entry point, but the correction is not going to be very severe.
Yeah, I think people have been waiting for that correction, I think, for the last few months. And that's been apparent in terms of the flows, what we are seeing into the mutual fund, which has been negative. I think waiting for that correction, you never know, I think, when that will come in. And see, you are waiting for the big picture, right? If even from here, okay, as I said, okay, we have not missed the bus. Okay, we are probably just about starting to make a beginning in terms of boarding the bus. The journey is still long away. And the returns in the medium to long term, as I mentioned earlier, looking at the kind of earnings growth we are looking at and looking at where the market is, in the P multiples are expensive, but on price to book value, market is still near this long-term average. So it would be important for investors to start investing. If there is a correction, you can put in more money, right? But if you just wait for that correction, I think it will, you will probably miss the bus. and then it's difficult to catch a running bus, right?
Mahesh, how
So
would
I
you?
would say the SIP is the best route. I think many people have. I think in India we've seen this SIP culture pick up pretty well in the last 2-3 years. I think one should continue to do that because that has showed that even in investors. Okay, I remember. I mean, we just look at the data. People who came in at the peak of the bull market, right, in 2008, and continued with the SIP from there, they have still made almost 10 to 11% returns.
Just make that point again, Mahesh. It's an important point. If you came at the peak of the bull market 2008 and then markets
Yes.
corrected 50%, you did not cancel your SIPs, you've actually made a double-digit return.
Yes.
So more
Yes,
more money is made. I'm bringing this point out perhaps on behalf of Mahesh and something that is a channel which we endorse, that more money is made by spending time in the market, by not really timing the market. Always remember that SIP for an average investor is the best route. Mahesh, what should one not do in this decade? What are you planning not to buy, not to invest in, so that you can maximize returns? Because investing is also about avoiding mistakes.
Sure. No, I think what we have learned in the last years, many years at least in my investing, is that I mean there are various opportunities you get in the market, but I think betting on the wrong company, betting on the wrong management is the biggest mistake you can make. I think sectors, you could see sector rotation happens. Okay, a sector could be bad for a couple of years, 2-3 years. Okay, it can come back. So I don't think I will avoid any sectors, right? A sector which is not done well in the last 2-3 years, probably it's time for it to invest. Like for example, pharma sector didn't do well for the last 2-3 years. And a year back, we went aggressive on the pharma sector. We launched a pharma fund that gave almost like 70% return. So I think the biggest mistake is to really backing the wrong company and the wrong management. And the markets have been very discerning, right? Wherever companies have failed on corporate governance, promoters have misallocated capital, markets have punished them heavily. And the P's have derated and the companies have not been able to really come back. So I think that's the only, mistake or what I would stay away. Not only this decade, but I mean, that will be the mantra really to follow at any point in time.
There's two more follow-up questions and something which just occurred to me 2 days ago, which is that we are comparing this budget to be a budget which is as strong as 1991. Should we remind everyone that after 1991, 2 years after the big budget, you had a big scam which happened on Dalal Street, and then there was coalition politics. Do you think this time, at least chances of that is not there, and this indeed is going to be a great path of recovery because of the budget?
So I think what has happened in that period, I think our systems have been strengthened multifold. I think both our regulators have been really prompt, and actually we have much more regulation in India than probably in some of the developed markets. I mean, I'm just looking at our retail. I mean, some of the markets like in China or other Asian markets, we've seen the huge amount of retail money coming in the US, and that money has come on leverage, right? Because the financial institutions there are providing at low interest rates. And that money in India, we haven't seen that. Our regulators have been very, very tight in terms of curbing that. We have seen new norms coming in terms of margin funding. So I think I think the way the regulation has shaped up in India and regulators have behaved, I think we are much ahead of the curve. Right? I don't see those kind of mishaps what we saw. Right? That typical problem when in a bull market, right? In a real bull market, when there is amount of liquidity, okay, you can see those kind of scams or those kind of bubbles which get created, and then there's a big bust and there is a huge despair for investors. I think we are trading very, very cautiously a regulator. I think I don't see that bubble at all. Even the market where there are, frankly, I'm not seeing any bubble, at least in terms of domestic retail investors.
Just to wrap it up with one more point, Mahesh, and I'm going to challenge your point on retail investors. When you see an episode like GameStop, when you see a social media forum, investors and traders, they come together and they can, even the price of silver goes up and down. When you see the excitement in the euphoria in the IPO market, don't you get worried? Because the masters of the market always say, beta, do cheez ka dhyan rakhna. IPO market ka euphoria or retail participation. Right now we have both.
Yeah. So see, there is some amount of retail, but by and large, if you look at overall, see in as I mentioned earlier, there is some amount of euphoria. We see retail money, retail investors coming directly into the market, and that's been reflected in terms of new mutual, the demat accounts which have been opened. But overall, if you look at it in the gamut of things, at least I'm not seeing that euphoria. It's not leverage money which is coming in a big way. So while I'm worried when retail investors chase some penny stocks, okay, and that goes up, and we see what happens to those companies. But I think investors should be aware and careful, and that's the reason why I think they should give money to professional managers. And I think it is high time that you see money outflows, what we see in mutual funds. I think what has happened is that the sharp rally in the market has emboldened everyone. Everybody thinks that he can make money quickly, right, in the market. And that's what has led to this retail participation. But I think markets is not going to be the straight rally what we have seen. You will see some pullbacks, correction in the market, some amount of volatility will creep in. And I think it's best to really put money in the hands of professional managers. And there are various ways you can actually do this. There are multiple funds, okay, with different risk appetite which you could invest into. So, yeah, I would say retail investors should really be cautious at this point in time because everything is going up. We're still not really into that bubble phase, but you might go there, and I think it's advisable, okay, to be cautious.
Before I wrap, I know Sumit had a question. I can preempt his question because we've been working for years now, and Sumit wants to know, Mahesh, that which is one non-Birla scheme you would advise people to invest in?
I would say you put money in our asset allocation fund. Okay, we have a multi-asset fund. Okay, where you will get where we not only invest into Birla funds but also outside Birla funds. So I think that's the fund you could look at.